Hello, everyone. Very pleased you could join us today. My name is Olga Piwat, and I'm a researcher of IFI Global. Welcome to the second of our magazine programs, which we have called Vision. I'm here to operate technology and make sure that everything goes as smoothly as possible. I'm now going to hand over to Simon.
Thank you, Olga, and welcome also from me to, as Olga says, our second monthly magazine program. IFI Global Vision is supposed to be more informal and easygoing than some of our other events, and also perhaps I should say a little bit more provocative potentially and challenging for those interviewees we have coming up as well. Today, I'm going to be talking to Brian Lavery, who's a director at PwC in Dublin, about the proposal to bring in a global minimum corporation tax and what that would mean for Ireland and indeed for the fund industry elsewhere. I'm also going to be talking to Rob Hersov, who is the chairman of Invest Africa, about investing in Africa. It's a part of the world I don't think we and many others spend enough time focusing upon, and I think some very interesting things to say about what's going on in Africa. But we are going to start with Gary Linford, who is the founder of High Water, which is a fund governance firm based in Cayman, about what has been going on there recently. Just before all of that, let me quickly tell you about three things that are coming up, because once we get into these discussions, I would otherwise forget. On Thursday, we are hosting one of our more formal, slightly longer events on the impact of ESG on service provider selection. That is in effect a curtain raiser for two very large research studies we've been involved in, both in the UK and the US, with fund managers on how ESG is changing their business practices, and that includes a section on service provider selection. The results so far have been absolutely fascinating because they've been incredibly varied, both here in the UK and also in the US. So that's coming up very soon. We have, at the end of the month, the results of a very long and extensive consultation we've been doing with the industry on transparency and fund board composition, and that is on the 29th of June. And then we're going to be putting forward policy recommendations to regulators and to investors based upon the body of evidence that we've been compiling over the last few months. And perhaps the biggest one here on the screen is the launch of FSI, which stands for Fund Structuring International. This is going to be our fourth publication. It launches in September. It's going to have a slightly different business model just for the US market than our other publications. The other publications we have, all three of them are all strictly paid. This is going to be free on request to alternative managers in the US and their advisors. It provides advice, news, information, and a whole host of other things for US managers, particularly when they're looking to go overseas, focusing on things like governance, fund domiciliation, service provider selection in the ESG era, etc. It's very research orientated entity as well as being a publication, and we start the research for that next month in July, with the publication beginning, as I say, in September. So now I'm going to stop sharing screen. Olga here, thank goodness, to work the technology. Olga, I'm going to make you the host, that's correct, and we're going to bring Gary Linford up onto the screen. So you should be the host now. Gary, if you're there, please come on up and we will get started.
Okay. Oh, interesting. And remote panelist. Yeah.
If you managed to locate Gary.
Yeah.
Great. Well, whilst he's coming, oh, there you are, Gary.
Yeah,
hi, fantastic. Let me do a bigger introduction of you. I just said you're the founder of High Water, which is a very well-known fund governance firm based in Cayman. And particularly relevant for today's discussion is that he was the former head of investments and securities at SEMA. In light of the bizarre public falling out between CIMA and Maples, the biggest law firm in Cayman and probably almost certainly the biggest service provider too. I thought it would be a really good idea to get Gary to come along to explain what is going on. But first, quickly, some background. Cayman was blacklisted by the EU early last year. It came off the blacklist in October. Then the EU Parliament made clear it wanted Cayman to go back on the blacklist, and then the FATF grey-listed Cayman, and then CIMA started to really clamp down and find Intertrust recently about $5 million, wasn't it, Gary? And
yes.
Got into a public fight with Maples. I just want, before turning over to Gary, I just want to quote a couple of things that CIMA put in its press release about Maples. I've never seen anything like this before in many decades of reading press releases, least of all from a regulator. It called Maples' actions irresponsible, inappropriate. It called Maples crafty. It said it viewed their actions with extreme concern. So Gary, can you answer what is going on in Cayman right now?
Well, first of all, thank you, Simon and Olga. Look, it's 15 years ago that I worked at CIMA, and I only did a short stint there, so I can't speak for CIMA. I also can't speak for Maples, but I can give you some sort of nuance of what's going on and why I think journalists and organizations like yourselves maybe take such a provocative stance with Cayman without really understanding some of the issues in more detail. So let me kind of go back to what's prompted all of this. You're quite right. The FATF has put us on the grey list. But first of all, what does that mean? We're compliant, or largely compliant, Simon, with 39 of the 40 principles, right? You said in the UK, you're only compliant with 38. Italy's 38. Italy's constant, thorn in the side of Cayman saying that we're a bunch of tax evaders and things like that. They give us a hard time on organizations like IOSCO. They're only 38. The US is 31 and Canada's 29. I don't see any of them grey listed or blacklisted. But having said that, I think we'd probably be 40 if we had to be re-rated today, because the one area that they marked us down when we had the 39 was our lack of a legal framework around digital assets. And we've now passed the virtual asset service providers law. So I think we're in good shape. The one area that wasn't a failure of one of their principles, but actually has caused all the difficulties in Cayman and some of these fines, is their belief that there's an inappropriate enforcement of the laws. So while we have those laws and we get the tick on the principles, they don't believe there's enough enforcement, which I think has partly led to the use of CIMA of the fines registration. Because in the past, Simon, one of the difficulties, certainly when I was there, was when you wanted to take some action against somebody, you'd have to go to court. And sometimes the actions were just over routine issues. And so recently, CIMA has this new power now of levying these administrative fines. But if they levy them against every single infraction, they quickly add up, which is what we saw with Intertrust, right? So one of the problems with this, and which I wanted to share with you today, is, that these bad acts that people are concerned with Cayman, they don't take place in Cayman. What are the bad acts? The bad acts are insider trading, wall crossing, Ponzi schemes, frauds, regulatory arbitrage, money laundering. They take place in your country club in the UK. They don't take place here in Cayman. The ill-gotten gains might land up in Cayman. That I accept in structures. However, CIMA, Simon, has been so cooperative with all these national regulators. I don't know the exact number, but I remember from my days there, it was something like 90%, 96%, maybe as high as that, where CIMA works with national regulators to provide access to the Cayman service providers so that they can get the information they need to pursue these bad acts. And if indeed the ill-gotten gains did fall into one of these Cayman vehicles, you know, SEMA would do its part to ensure that those ill-gotten gains were disgorged. So from that perspective, you know, the focus on us being on the grey list is frustrating.
Why, Gary, do you think, in all honesty, we had a good chat about this on our prep call, why do you think Cayman gets such bad press internationally? Probably worse than any other international fund jurisdiction or major offshore center.
I don't think people appreciate that zero tax means investors are taxed back home. You know,
well, that applies to other jurisdictions too, but Cayman seems to get it more in the neck than others.
Yeah, I think it's partly also jurisdictional competitiveness, right? Places like Jersey, Dublin, and Luxembourg, I mean, they should caucus with us when we challenge the nonsense that comes out of some of the EU politicians, but they don't do it because they actually compete with us. You know, and so in some respects it's frustrating, because one of the things I would love to see is, you know, jurisdictions that are facilitating international trade with all the transparency that you need and all the compliance with FATF, bandy together to fight some of the political nonsense. I mean, some of the crap that comes out of the EU. That one politician, you know, said, if there's a blacklist and Cayman's not on it, that's not a list. You know,
this is the point. That's what I'm talking about. Cayman being singled out for special punishment, which brings me on to the blacklist. I said in my introduction that you guys were put on the blacklist in, was it February last year, and you came off in October. We all thought that was all over. You're quoting something, I think, from the EU Parliament in January this year. And there is talk, and probably more than talk, that Cayman's going to go on the blacklist. What would that mean? I know you're going to say the vast majority of your business is with the US and Asia. What would that mean, though, for your reputation if you are blacklisted again? Would it be how much of a problem would it be?
Look, I don't think any of us like being on that list. I mean, it's just, you know, it implies that we're doing something wrong, and the frustration when we're not. You know, I explained to you how much legislation we've passed. People like yourselves and the FT, they never write about, you know, the extent of the legislation that's been passed. And we've had the beneficial ownership regime to comply with all the beneficial ownership issues that arose in the EU, and we agreed with the UK government, and we signed up to beneficial ownership. To get off the blacklist of the EU, we signed up to the private funds legislation. We've got the economic substance for the whole BEPS. You know, we've got enhanced money laundering that we introduced. You have to have a compliance officer appointed to a fund. You don't get that in Europe. It's still with the manager, right? And so we now have, with our Cayman funds, the fund administrator doing an AML due diligence, a compliance officer checking the fund administrator, and the board checking the compliance officer and the fund administrator. I mean, it's just over the top. But we do it, right? We have to get off the blacklist. We've had the director registration regime, and we've now had this latest improved disclosure in the PPM. So I think we're doing everything that we can, as well as being compliant, you know, 39 of the 40 principles with the FATF. So I do think it's bias.
Sorry to interrupt, you say it's biased, but I'm going to give you, I quoted a real own goal. This is from no outsider. I really do mean this. I've never seen a press release, let alone from a regulator like the one that SEMA came up with a few weeks ago, directed at Naples. That's, you know, we admit, you know, we published that, but, you know, we were an independent publication. That's an own goal. What on earth was behind all that? Have you got to the bottom of that?
Fair enough. Look, I think there's a bit. I think there's a middle line here. I think it was unfortunate. I think there's a lot of frustration, right? So SEMA doesn't dream up the legislation. It's kind of driven by the politicians. So the politicians negotiate. SEMA obviously works with the politicians to make sure that they can implement things. But I think with us going onto this grey list, I mentioned earlier about enforcement. I think there's been some pressure on SEMA to make use of the administrative fines. And my understanding, I don't have any inside knowledge here, but my understanding from listening to the talk on the island is that some of those that are being charged these fines, there's legacy business, and perhaps they didn't devote enough resources to the legacy business to fix things. But when you get a 5 million fine, the perception is that you're involved in money laundering or something, but I don't know that that's necessarily true. I think the 5 million fine is an aggregate of a whole lot of infractions, like, you know, no updated passport and things like that. So I think there's a level of frustration there. The other level of frustration I think that comes into the Maples and SEMA spat is probably to do with SEMA's interpretation of their own regulations, and where they haven't provided guidance, they're now interpreting things differently to industry, and I think there's some level of frustration there. I'll give you an example, and I've got no idea whether this was in the Maples situation that they've taken SEMA to judicial review. But in my own experience, the private funds regime comes in, and we have structures that aren't necessarily funds, and there's certain waivers. So for example, SEMA says if you've got a special purpose vehicle, it's not a fund, it gets a waiver from the private funds registration regime. And then they go, and we will produce, you know, interpretive guidance explaining what an SPV is. Well, 1 year later, we've still got the law, but we've got no interpretive guidance. So there's some frustration there. SEMA's also got all this legislation they're trying to deal with, and they've been resourcing up, but I think there's a level of frustration there with the amount that they have to deal with. And that comes from the FATF, you know, having these inappropriate views of Cayman. So I sort of start with the FATF and it kind of filters down. Now, what I can't do is I can't say to you that SEMA's response to Maples and Maples' decision to go to judicial review is what we want. Having said that, there is a level of frustration with SEMA's interpretation of some of the regulations and laws, and maybe the judicial review will resolve that, and you know, and it won't be a bad outcome to have the courts determine where SEMA has gone right and where they've gone wrong, and could give some proper guidance to industry. And it's not unlike other jurisdictions where people challenge their regulators. I can't argue with you on the tone of the press release. I have to just concede that that was unfortunate, and you know, I can't justify either party in terms of their press release, but I can understand that there's a level of frustration that's taking, you know, that a firm that has guided SEMA in the past with crafting legislation is now challenging them under judicial review. So yeah, I can't, you know, I'm repeating myself now, but I can't justify or explain the tone of the press releases, but I can understand the aggravation and frustration by parties in the situation we find ourselves in.
Well, thank you. Cayman is, when I mentioned the launch of our US publication, which is only a few months away, we're absolutely coming back to all of this in more detail. Gary, thank you very much for being on our Vision magazine program. Much appreciated. Have a good day. You're up in Canada, aren't you? Hope you can hang around for the rest of the show. Olga, do you mind putting Gary back in the audience and bringing up Brian Lavery? So we're now going to switch to a related subject, which is global corporation tax, which may have some implications for Cayman too.
Bye, so Gary. Hopefully, I'm going to change your role to attendee now, okay. So bye.
Bye-bye.
Okay,
hopefully the technology, we'll keep our fingers crossed, we'll carry on working, and we'll get Brian up.
And now we're bringing in Brian, promote to panelist. I did it, and Brian should be with us. Yeah.
Hey, it looks like it's all working. God, this is amazing.
Yeah, we got this. I think so, right?
Brian, as you're coming up, let me repeat, you are a Director of International Tax and Financial Services.
Hi, guys.
At PwC in Ireland. So you're perfectly, it's a combination of the international tax and financial services, along with the fact you're based in Dublin, to talk about the interesting development. It's not guaranteed, we all know, but it's, one would have thought, reasonably likely, that we are potentially looking at a minimum global corporation tax. That's how it's at least appearing at the moment. But before that, by way of introduction, let me just say, you guys in Ireland have been under the cosh a bit with the EU threatening not to give you pandemic relief funds unless you agree to increase your corporation tax. That's before the G7 waded in. So there's an awful lot going on tax in Ireland. So let me come to the first question. What are the ramifications of a minimum 15% corporation tax for Ireland, Brian?
Yeah, and I think that's a good place to start. I think firstly, it's important to note that the 15% minimum rate hasn't been decided on by the wider global community, i.e. the G20, the OECD, the EU. The 15% rate has been endorsed by the G7, by its name, a group of 7 developed countries who are all conscious of the need to bolster their own tax revenues to pay for, the COVID pandemic relief in their own countries. And ultimately, they're going to be the ones who are the winners of any 15% minimum tax coming in. So before anything can actually happen, and I think you made the point about how likely it looks, before anything can actually happen, it will need to be approved by kind of this wider inclusive framework. And there's 139 countries in the OECD, all of whom have maybe very different ideas of what the rate should be. And, back to your point on the EU, some of the countries within the EU, Ireland is one, Malta, Cyprus, have lower rates than the 15% that they're talking about bringing in. And they could move to block any implementation of the 15% rate at an EU level. And I think it's important to note that any EU directive needs unanimous consent from the constituent countries of the EU. So, on that basis, if we look at the rate, I think 15% would probably appear to be at the upper end of the range. Particularly given that any higher rate is probably unlikely to pass in the US through Congress. So, on balance, at the end of the day, we would probably say agreement, maybe for a slightly lower rate is probably preferable to no agreement at all. And I can definitely see a situation where the rate would fall somewhere between, any rate that does come in, would fall somewhere between 9 and 12.5%, which was actually the rate, you may have heard of BEPS 2.0, which is an OECD initiative. And one part of that was also a global minimum tax. And 12.5% was the rate that was spoken about by the OECD at that point in time. And, this is me just coming at it with my green glasses on from Ireland. These are actually very real possibilities of what actually might happen. And I think they have a good chance of actually coming to pass. But I think the overall message is that there's still a lot to be undecided. In terms of how, back to your long-winded way of getting to your actual question, how the 15% rate might actually apply to Ireland. I think it will ultimately depend on, does Ireland stick with 12.5%, or do we, raise our rate to match whatever the minimum rate that might come in? The indications that we've got from the Department of Finance so far are that, we'll hold tight and keep the 12.5% rate. I think it's been made quite clear by the current government and by previous governments as well that the view is that smaller jurisdictions and economies, smaller open economies like Ireland, should be able to use tax as a lever to compete against the bigger economies, who have economies of scale, with respect to attracting foreign direct investment. And this came out again. They released a 2021 economic kind of recovery plan post pandemic, and it was restated again in there that the 12.5% rate is it's our rate and we're sticking by it. And unusually, I would say, for Irish politics, there's consensus across the spectrum and across political parties that the 12.5% rate is the right thing to stick with. If I think about, if we look at the 15% rate and say that's the rate, how is that going to actually impact Ireland? There's probably 2 areas that you can
focus on how it would affect financial services in particular. Yeah, if you don't know.
Oh yeah. So if you look at the Irish fund industry then specifically, so. As a general point, again, unclear how the rate's going to apply or how the framework will apply to kind of funds or financial services generally. But, if you look at the Irish funds industry, I think it's very clear to say that it won't have an impact because tax is not the driver of the Irish funds industry. When we look at it from product perspective, service provider perspective, fund management perspective, Ireland has been a key player in both the European and global funds landscape for this year is the 30th anniversary of the Irish Funds Industry Association, Irish Funds. And that far predates the implementation of the 12.5% rate in Ireland. That only came in 2003. But if we look at it from specifically from an Irish product perspective, you could go anywhere in the world and set up, tax-free product. We just had, Gary on from Cayman, they have great tax-free products as well. But what makes Ireland kind of attractive for our product is the fact that we're obviously in the EU. We're the only English-speaking country in the EU. We have our products regulated under UCITS and AIFMD. We have this 30, like the very first UCITS platform in Ireland was 1989. So we have over 30 years of, a very, very good, strong track record for our regulated products. It's, across Europe, the US, Latin America, Asia, it's all very well respected product. And I think really importantly, and, it's the theme of what we just spoke about from a regulator perspective, Ireland has a regulator who's been regulating these products for 30 years. So they know what they're doing. They're business friendly, they're practical. And I think that makes a very big difference. So if we bring it back to the service. Sorry, go ahead.
Can I jump in? Because I'm going to just ask you to slide effortlessly from the Irish situation to the global situation for corporation tax, because we haven't got very long, I'm afraid. So to ask you, do you think it could have an effect upon any of the global service providers in Dublin itself? And perhaps at the same time, you could take the next question, which is, how might it affect those global service providers in other jurisdictions too? Because many of those firms got operations in offshore centres. I mean, some of them might have operations in Cayman. We're just talking about Intertrust there, and they're fine in Cayman, but also there's the State Streets and all the others. We've got offices in all these international jurisdictions. Do you think what would the effect be, both A in Ireland and B on their global operations, including offshore, or if there was to be, as you say, it's not guaranteed, but if there was to be a corporation tax, global minimum corporation tax? Yeah.
So, I personally think that a key differentiator of the funds industry generally is that the service providers follow the product. That's the key. People, Ireland has this great product, so we have a service provider industry that's set up around it. Do I think the tax is going to impact what happens in Ireland? No. If you take a step back and say, how's it going to impact service providers across all Europe, offshore jurisdictions who operate globally, you're looking again, let's say if we look at the offshore funds industry, it's the same, these guys have a 30, 40, 50-year track record. So the service provider industries that have built up in those jurisdictions have been built up again over, a long period of time. So the infrastructure is there, the expertise, the experience, everything is there in those jurisdictions. So do I think that because this new tax rates just has been imposed, or potentially has been imposed, is that going to end up in people scooping up their activities or their substance from offshore jurisdictions and moving them to onshore higher tax jurisdictions? I don't think so. Gary made a good point about Cayman. No tax doesn't mean that things aren't taxed back in people's home jurisdictions. So that obviously was made in the context of investors, but it's equally relevant in the context of service providers. Your big players, they're all headquartered out of the US, the UK, elsewhere. When those profits move back there, they're taxed at that point. So, fine, maybe it's a low tax or no tax jurisdiction initially, but tax isn't the driver of why those, people have set up. They're following the product because that's where they want to be based, close to the product to service it. Now, I think what we can say in the context of the global funds industry is that over the last 5, 7, 10 years, there's been a shift towards onshore regulated products more generally. I'd say predominantly, EU institutional investors. So if you look at, and particularly in the alternatives industry, I would say as well. So where's all this capital coming from? Sovereign wealth funds, insurance money, pension funds. We're doing due diligence on behalf of these guys, and the questions that are coming up are around, is it regulated? What's the ESG status? What's the tax integrity rating? These are all the questions that are being asked, and there is definitely a shift in our experience, certainly, towards these onshore regulated products. And I think that trend, more than a position of a rate, is actually what we might see some movement, because all of a sudden you're going to have these products more focused towards your onshore regulated jurisdictions. But I think even if we look at it in the context of what we're talking about here, it's the narrative more than the actual tax rate that's probably going to push that conversation, because, as I said, the tax isn't the driver of why people set up in offshore jurisdictions, but it's the whole narrative that goes along with the product and then the surrounding industry that will, in my experience, push, move trends around.
So lastly, and very quickly, if you don't mind, if, and I repeat, it is still an if there was a global minimum corporation tax, you're saying, if I've understood you correctly, no change in even offshore jurisdictions as well as in Ireland. It's not going to affect the business one way or another. The business will carry on as it is. global corporation tax isn't going to make any difference to it?
Yeah, well, certainly in the case of Ireland. I think in the case of the offshore jurisdictions, as I said, I don't think the actual imposition of this minimum tax is going to, turn the needle completely. But it does certainly feeds into the narrative. And I think, and it was, again, I keep referring back to Gary, but, he made the point around, the regulator is very active already improving the standards in places like Cayman. And, those conversations are happening in all of your offshore jurisdictions currently. What is the framework that we want to operate in on a go forward basis? Tax and the whole tax narrative certainly feeds into that. But I would say, if you're looking at just, 0% to 15%, is that going to massively turn the needle when you take into everything else, take into account the fact that these profits are probably being taxed at a higher rate anyway, ultimately, I think I would agree with you there.
All right, well, thank you very, very much, Brian, for being here on with us on IFI Global Vision. Much appreciated. Thank you very much for your responses and your optimistic view that A, it may well not happen, and B, if it does, so what, because it's not going to really affect Ireland or even necessarily the industry in other jurisdictions either. So I'm going to call on Olga again to put you back into the, Brian back into the audience, and we hopefully have Rob, who's been on a very important call from he's based in South Africa with a big investor in the Middle East. And hopefully, Rob, you are there and we'll be able to call you up. I'm hoping whilst we get Rob up, he may have we had an incredibly good prep call with him with Table Mountain in the background. He was in a vineyard when we had our prep call. And Rob, so I don't know whether we're going to have the same glamorous background today as we did on the prep call. Look, there he is. No, we don't have the vineyard, Rob. What a shame. But anyway, very nice to see you. Thank you very much for joining us. Let me introduce you more formally. Rob is a South African entrepreneur and an investor who owns several companies. He's the chair and founder of Invest Africa, African Capital Investments, African Gold Acquisition Corp, and Alternative Capital. Have I missed anything out there, Rob?
Well, you've missed two. The one is a relatively recent announcement where a business partner and buddy of mine, Nick Ferguson, and I have bought an airport. We've renamed it Cape Winelands Airport, and our aim is to make it the second airport of the Cape Province of Cape Town. So, fantastic. And big announcement that I'll make within this conversation.
All right. Are you going to make the big announcement now, or are you going to wait it?
Well, it's with two of the biggest names in technology in the world, Hans Otterling of North Zone, and North Zone is this sort of, Sequoia is the North Zone of America, is the right way around. Or you could say North Zone is the Sequoia of Europe. But North Zone has had 9 funds. I think they've deployed over 2 billion euros. Every fund has had 25% IRR plus returns. I mean, that is something else, every fund. And they have 12 unicorns, 2 decacorns within their portfolio, Spotify and Klarna. Spotify, I think, made 1,000 times money, and North Zone invested $20 million at a 40 million pre-money valuation. And Klarna is now the most valuable private tech company in Europe. And Hans Otterling is a principal of North Zone. Nicholas Adelberth is a co-founder of Klarna. The two of them and I, $200 million African Technology Growth Fund.
Fantastic. Announced on IFI Global Vision. Announced on IFI Global. Oh, thank you very much. This is a scoop for us. Now, you said on our prep call that you've spent many years of your career, in effect, don't want to put this too crudely, taking money out of Africa, investing it around the world. But now at this stage, you're actually putting money back in. You've traveled around. You've met many presidents in many African countries. Why now? What's the African story? Because what you said on our prep call makes it sound incredibly exciting. So I'm delighted you're here to tell us about it.
There are 55 countries in Africa. The four biggest, Egypt, Nigeria, South Africa, Kenya, are roughly each the size of Detroit. Michigan. And you wouldn't go and launch a business just for the state of Michigan, would you? But in Africa, there are 55 countries. I've been to 35 of them. Some of them I really have no interest in ever going back to. Many of them are tiny, complicated. I can understand why a lot of people look at Africa and go, just too hard. But there are two sectors that really interest me. One is mining, and mining is forever. You're always going to need things that are dug out of the ground and turned into something else. And Africa has more than enough of everything. So mining is a well-trodden part of Africa. Does depend on what you're mining and in which country, but in general, it's a great business to be in. You know, a man like Mark Bristow, a rock star in mining, is from Africa, from South Africa. And he's now the #1 and most profitable mining man in the world. But the other area is technology. And technology, the time is now. Africa, 3 unicorns this year with more coming. And all the investment that's been made in technology by the DFIs, by family offices, by venture investors is beginning to bear fruit. And very quickly, there's one macro trend that a lot of people are missing. Africa has 1.2 billion people. 60% are under the age of 25, and the average age is 19. And everybody has a mobile device. They'll buy this before they buy the next a pair of shoes. So what it means is that in the next 10 years, those 19-year-olds, 25-year-olds are going to be 29, 35 years old and will be the continent forever. And I'll give you quickly the 4 areas we're focused on. Fintech, education technology, health technology, and an area we call market enablement, which is kind of e-commerce, regulation technology. It's a catch-all for the other areas. And in those 4 broad areas, Africa will change forever, happening as we speak. Take, for example, a village in the middle of Africa, where children have had no other option than having one teacher under a tree or in some sort of classroom, teaching them all the subjects for their whole school career, which may only be 5 or 6 years long. That's going to change, and it's changing now. This device gets them straight to Harvard Online or Oxford Online or, you know, wherever. Any education you want, you can get through a device through the internet. And
do they have the Wi-Fi and the infrastructure to do that everywhere?
Yes, you're going to have it everywhere very soon. Cables have been laid, subsea cables, you know, 5G's coming in. You can get internet through satellite. You can buy it at your local shop, but there's no excuse anymore for people not having the best education, the best health. Telemedicine's, you know, instead of going to the local village to see the local doctor who's a poor man or woman, has to handle every single disease, you go straight online to the best doctors in India, America, Germany, or Switzerland. You'll have telemedicine, you'll have fintechs already happening in Africa. You know, why rely on corrupt and useless governments in Africa when you can just go straight through a fintech system built by a Nigerian, South African, or Kenyan entrepreneur? It's happening as we speak. So in Europe and America, you know, there's huge competition for transactions, for tech transactions. And the problem is, you know, if companies get funding in Europe, you know, they're often, the valuations are through the roof. They're very heady. But what do they do with the money? They say, I'm going to hire the best people out there. And they're going to hire from other portfolio companies. Do you know that the average retention rate in Silicon Valley is 6 months?
Wow.
The data scientists last 6 months per company, and they just get hired by. So there's a lack of talent, valuations are heady, and you know, it's just overly competitive. But in Africa, Africa is Stockholm 2005. When
Can I
things
ask you, it sounds incredible, and I have to admit, I'm convinced, and, you know, maybe, you know, Penny's, you know, I should be investing in Africa too, because there's not much else to invest in right now. There's not really any other market. There aren't really other frontier markets anywhere in the world. The rest of the world becomes so boring to invest in. And I agree, Africa is an opportunity. But so I want to say that first before giving you a couple of negatives. I think I'm right in saying private equity returns, which has been the main vehicle a lot of people have used for getting into Africa over the years, over the last decade. We hosted an event, however many years ago, 7 or 8 years ago, and it was basically all private equity managers talking about, you know, the opportunity in Africa. They were saying some of the same kind of things that you've been saying now. But let's face it, the PE returns have been disappointing. Is that a fair comment?
More than fair. You know, the best private equity firms are probably Actis, Helios, DPI. I mean, I'm going to get into trouble just for mentioning those three. You know, Abrage through fraud imploded, and that has set Africa back a number of years. And the aristocrats of PE investing in Africa, Helios, Actis, and DPI, you know, 2 times returns. Even
Why?
that's just
What's the problem? Why has it not been any better?
because I think the markets are too small. If you're in a normal, fast-moving consumer goods business in the Côte d'Ivoire, you know, how big is the middle class? It's tiny. You know, South Africa probably has the biggest middle class, and it's not a big middle class either, and it's quite a sophisticated market, but it's downhill from there. I don't think Mozambique even has a middle class yet. So all the private equity people that piled in are selling to tiny, tiny markets. But that's not the case with mining, because the product goes overseas. And technology, you know, it's a digital product. You can't have governments getting in the way. Governments can't. How do they stop someone buying a digital product or service? Can't. It's wonderful. We're going to leapfrog these governments.
Another problem is that a lot of, you know, this has come up again and again in Africa. A lot of it is dependent upon the largesse, whatever, of governments in various countries. You have to be in with the government. You know, dare I raise the subject of corruption? And that's been an obvious problem in probably many countries, you know much better than me. How much has that held things back? And is there still that same problem with having to pay your way into various governments and various markets you want to get into?
Look, corruption is endemic in Africa. It's from top to bottom in Nigeria, and the ANC has introduced corruption at a grand scale to South Africa. I mean, the ANC is morally corrupt to the core. It's an evil mafia gangster organization. And some people go, well, that was Zuma ANC. It's no different under Cyril Ramaphosa. I mean, he's a much better version. But they're corrupt. The ANC are corrupt. And, you know, they're introducing expropriation without compensation. Just those 3 words say it all. It will be a weaponized way of stealing. They've got black empowerment, which hasn't worked. Another way to steal, corruption. So the ANC act out this good and the great. They're as bad as everyone else. But there are countries in Africa that have got it right. Rwanda, Paul Kagame, absolute, you know, Switzerland is the Rwanda of Europe. That's how I like to put it. You know, Ghana's a good country. Côte d'Ivoire is a good country. Senegal's a good country. Namibia, Botswana, tiny. Mauritius and the Seychelles, tiny. There are probably 10 countries I would invest in outside of mining and technology. 10 out of 55. I mean, it's embarrassing. Let me put one thing quickly in proportion. I think Russia, China are way more corrupt than any African country. So, you know,
and a lot of the infrastructure in Africa has been built by the Chinese, of course, hasn't it?
Yeah, but they build it for 500 million.
We're talking about.
They build it for 500 million, and then they steal 2 billion of something else. So the Chinese, they're no fools. They know what they're doing. So corruption in Africa is bad, but not as bad as many other countries in the world. It's actually better. What's the problem with Africa is bad governance. You just get old crocodiles, lunatics, socialists. I mean, how can anyone still believe socialism works? You've got to be fundamentally stupid to think socialism still works. But people do, because the left captured the education agenda a long time ago. So we just have morons in charge. But the young and the entrepreneurs, through technology, we're going to leapfrog this problem. So I'm very confident in this space.
So to sum up, which this has been absolutely fascinating, delighted you're here to talk about this. So if I've understood you correctly, technology, the invention of the mobile phone, the fact that there's hopefully Wi-Fi everywhere, including in very rural parts of Africa, the opportunity is the demographic one. Like you are in Africa, the opposite of what we are in Europe, or indeed in Japan. You've got a very ambitious young population that's now got the wherewithal to potentially do great things in the next generation.
100%.
And it's all going to happen through technology.
And 3 unicorns have appeared this year. There are going to be a lot more coming through. Just watch this space. And I think the opportunities not in venture capital, it's the next level in growth. So series A, B, C. I think it's going to be a very exciting, and I'm so proud, you know, I'm watching great things happen. I'll be proud of Africa again.
Well, thank you. I said to you on our prep call, and I mean it, we're going to come back and do a more formal thing on Africa, because I think we need this. We've just been hardly even touching the surface. We will come back in a month or two's time and have a proper session with maybe you, hopefully, and a couple of fund managers talking about, you know, the whole subject in a lot more detail, because it is probably at the moment the only place in the world that's vaguely interesting from an investing point of view. You know, what's the point in investing on an ETF in New York or London? You know, that doesn't do anything for anybody. You know, it's just going down the casino.
Quick question. Somebody, Shane Norman, has asked a question, and do I respond by typing or what?
Sorry. Let me. Oh yes. Well, yeah. We didn't really have questions. We normally have questions, but do you want to answer that one very quickly?
Look,
well,
Shane, it's a very good question. You know, the people will buy a mobile phone and airtime ahead of almost any other good, including shoes. You'll have people not wearing shoes in order to afford this and airtime. It's the greatest priority because it solves so many other issues. And of the 600 million under 25-year-olds, you only need 300-400 million of them to have one of these, and you've got businesses booming everywhere. That's what's happening.
And that is as good a note to end on as we could possibly think of. Rob, thank you very much for joining us today. Hopefully we will be back. Good luck with all your ventures. And thank you everybody who's joined the second magazine program of ours. I hope you like the format, and we will be back next month with more. Thank you. Have a good afternoon, morning, evening, wherever you may be in the world, and see you the next time. Bye-bye, everybody.
Yeah, thank you. Bye-bye.